Hello and welcome to this preview of The Banker's April issue. I'm Brian Caplen, the editor. I'm with Kat van Hoof, Capital Markets editor. And Kat, you wrote the cover story for the April issue, and it's about the build-up of corporate debt. So what actually is the problem then?
So actually, to know what happened and where we are right now, we need to go back in time a little bit. As many things these days, these dynamics come from post-crises.
Yes.
Sort of monetary policies. So central banks, in order to stimulate economies, they instituted quantitative easing programs.
Right, which means low interest rates, really.
It does.
So it makes it attractive to borrow.
Exactly. It makes it attractive to borrow and to issue as well for corporates. So what you get is you get a massive market for corporate credit and low interest rates, so it's cheap. So essentially, the market has ballooned over the past few years, and that made it systemically a much more important asset class than it was.
Okay, and then obviously all this corporate debt is rated by the rating agencies. If we have problems ahead, is there a danger of downgrades in the ratings area?
I think a lot of the anxiety has to do with some of the BBB rated debt, definitely. So we've had a lot more corporate leverage at the moment than we've ever had before. So with corporations having put so much debt on the balance sheet, this creates a little bit of uncertainty and for sure a little bit of a soft spot there. If rates rise and the debt becomes much more expensive for them to pay back, this is going to be a difficulty for them to deal with. And some of these corporates have been downgraded into BBB territory, which is just above high yield bonds.
Right, so they're not very far away from the high yield market.
Exactly.
Okay. And I mean, what about the covenants on these kinds of loans? I mean, have they been as strong as they were before the crisis?
Well, so another issue, not so much to do with the bond side of things, but the loans market, which has also tripled in size, it's huge leverage loans now, is that the covenants have been loosened massively. So I don't think they've ever been quite this loose before. And so what you have is very highly levered balance sheets with very light covenants, meaning that actually the buyers of this debt have very little means to force the borrower to the table if things start going wrong. So if earnings drop or if they start, I don't know, getting into some sort of trouble, it is very difficult for the people who own the debt to do anything about it until potentially it is too late. So the guardrails have kind of come off. And this also leads to very little visibility down the line.
Yeah.
So there may be quite a few companies that are on the verge of defaulting, but we wouldn't know until it is too late. So,
all right, so investors should really be looking at all this very, very carefully indeed.
Exactly. So there's a lot of sort of soft spots where there isn't necessarily an issue yet, but I think also with an unexpected extra rate hike last year in the Fed, there is a bit of anxiety. I know they've said recently they wouldn't raise the interest rate for the foreseeable future, but it's changed its mind before and it can change it again. So we're in a very sort of sensitive time at the moment. So if anything changes, there are a few sort of dominoes that could fall, and they could well fall the wrong way for investors.
Kat, sounds very exciting. We'll look forward to reading it. Thank you very much.
Thank you.